Hello, I'm David Cassidy with the market summary for the week ending Friday, the 15th of January. While Donald Trump's impeachment grabbed the headlines last week, it had absolutely no impact on equity markets as Donald Trump's presidency naturally comes to an end this Wednesday, the 20th of January, with the inauguration of Joe Biden as president. Now, although normally this type of political theatre is a great example of the type of noise that we would normally filter out when managing clients' investments, unfortunately, on this particular occasion, we can't simply ignore it. Given the slowing US economy, it is very important that US politicians remain focused on getting Joe Biden's new and ambitious $1.9 trillion fiscal stimulus package agreed and passed, rather than becoming obsessed with impeachment proceedings. Otherwise, politicians fiddle while the economy burns will start to spring to mind. The need for this new fiscal stimulus was laid bare in last Thursday's weekly jobless claims data and also Friday's retail sales. The jobless claims data provided clear evidence that the US employment market is starting to lose momentum given the recent stricter coronavirus lockdowns, with initial claims for unemployment benefits climbing to 965,000 from 787,000 the week before, the highest reading since mid-August, incidentally. Continuing claims, which is a better indicator of ongoing US unemployment, were equally disappointing, with an increase of nearly 200,000 to 5.27 million. US retail sales also looked equally disappointing, falling to 0.7% in December. Now, obviously, with restaurants and high street stores closed, retail sales were likely to fall. However, the US control group sales reading, which excludes areas such as food services, car dealerships and petrol stations, and in the current environment gives us a more accurate picture of underlying consumer demand, also fell by 1.9%, suggesting to us that the weakness can't simply be blamed on lockdowns and that the US consumer may be starting to tighten their belts. Hence why Joe Biden's $1.9 trillion stimulus proposal, which includes $1.4 billion stimulus payments to eligible Americans and paid sick leave, is so important. However, it wasn't all doom and gloom. The Fed's Beige Book showed in aggregate modest growth across the US. The Empire State Survey showed that manufacturing continued to expand in January, and US industrial production rose by more than expected in December, with an increase of 1.6%, while November's reading was also revised up to 0.5%. Additionally, last week, despite all the market chatter regarding building inflationary pressures, which we've constantly dismissed, the US CPI inflation again showed no signs of any pressures, with a reading of 1.4%. And because we don't see inflation going anywhere in the near term, we have consistently gone out on the limb to argue that the US Central Bank was unlikely to tighten monetary policy anytime soon, let alone increase US interest rates. And thankfully, during a speech on Thursday, Jay Powell, the Fed chair, confirmed this when he said, quote, "Now is not the time to be talking about tightening," and that, quote, "when it does become appropriate, the Fed will give the market plenty of notice." Staying in the US, JP Morgan kicked off the US quarterly reporting season with a record fourth quarter profit of $12.1 billion. Now, this was not only 42% higher than this time last year, but absolutely trounced the forecasts made by Wall Street analysts after it released $2.9 billion of bad loan provisions. And as we said back in April, many US companies looked to us to be kitchen sinking their results when bad results were a given in order to boost future profits. Therefore, JP Morgan could be the first of many companies to report better than expected profits. In the UK, GDP data for November showed that the economy contracted by 2.6%. And while this may appear bad, this is actually a much better reading than we and the major economists expected given the lockdown restrictions. In fact, consensus estimates were for the economy to shrink by 4.6%. And as such, this bodes well for the Q4 GDP reading next month, as a double dip recession may now be avoided. Looking ahead this week, it is a shorter US week due to the Martin Luther King Day today, Monday the 18th of January, while the obvious big event will be Joe Biden's inauguration on Wednesday. Data-wise, we have US, UK, Eurozone PMI data, US housing data, weekly US jobless claims, UK and Eurozone CPI inflation, UK and Chinese retail sales, Chinese Q4 gross domestic product, Chinese industrial production, and a European Central Bank monetary policy meeting.